So we've spent a couple of weeks on this channel teaching about what infinite banking can do. Today I'm going to tell you about what it can't do. The limitations, the timelines, the situations where it doesn't make sense. The things that don't get talked about because they're inconvenient for people trying to sell you something. My goal isn't to sell something. My goal is an education on infinite banking concepts and how it works, and the full picture is included in this conversation. I'm Jared with Green Dot Wealth. If you've been following this series from the beginning, you know what we've been building towards. Back in week 1, I told you I'd be straightforward. This is what that looks like. If you're new here, welcome. And this might actually be a great place to start, because a person who leads with limitations is usually someone worth listening to when they talk about the benefits. Let's start with the one that catches most people off guard. Infinite banking is not a short-range strategy. It's not a get-rich-quick play. And if someone is pitching it to you that way, I wouldn't stick around for the conversation. In an earlier video, we talked about what it means to start a bank. You don't open the doors on Monday and turn a profit by Friday. You have to capitalize the institution first. You fund it. You build the infrastructure. You might operate at a loss or modest return for the early years while the foundation sets. That's exactly what the early years of a properly structured dividend-paying whole life insurance contract may look like. The cash value in the first few years may not impress you. It's not supposed to. You're pouring the foundation. You're not hanging the pictures. By years 5 through 10, the picture starts to change meaningfully. The compounding gains traction. The cash value begins to reflect the premiums you've been paying in a way that becomes genuinely useful. And from there, the growth that's uninterrupted, guaranteed, and increasingly powerful. But you have to get there. And getting there requires a time horizon and patience that the consumer mindset, one that evaluates everything on a quarterly basis, simply cannot sustain. It isn't a flaw, it's a feature. Because the families who commit to the long-range view are the ones who build something real. The ones who bail in year 3 because the numbers didn't look exciting, when the truth is they didn't stay. A second limitation, and this one's kind of connected to the first, properly structured dividend-paying whole life requires consistent premium payments. This is not optional. It's not flexible in the way a brokerage account or a savings account is flexible. Now, there are provisions within the contract design that provide some protection. If a hard season hits, paid-up additions can often be used. Policy loans can bridge the gap. But the base premium is a commitment. But it needs to be treated as something both meaningful and manageable and planned for when we talk about what your base policy would look like. That means the strategy is built for people with a stable, predictable income, or for business owners with structured finances. If your income is highly variable or you don't have a financial cushion, IBC may not be the right first move. There may be foundational work that could be done before the warehouse gets built. I say this directly, not with an intent to offend, but I'd rather have a conversation honestly up front than have you get into a contract or a policy that you can't sustain. Because a policy that lapses, one that gets abandoned because the premium becomes unmanageable, is a bad outcome for everyone. It validates the critics, it costs money, and it doesn't serve your family. The right time to start is when you're ready, not before. Third, and I think this is the most important limitation to name clearly, IBC is a foundation. It's not the complete financial plan on its own. Properly structured dividend-paying whole life will not replace a thoughtfully built investment portfolio with goals that include market-based growth. It will not replace proper estate planning, a will, or a trust structure. It will not replace a professional relationship that's needed with a good CPA, a good attorney, a good financial planner who understands the full picture. What it does give is every financial decision has a stronger foundation to stand on. It's a warehouse. It's an order of operations. It's the place your capital lives before it goes to work everywhere else. Think of it this way. A blueprint is not a house. But without the blueprint, your house has serious structural problems, no matter how nice the finishes are. IBC is the blueprint. Everything else still gets built, but now it's built on something solid. The families who use this strategy most effectively are the ones who integrate it into a complete financial picture, not the ones who treat it as a silver bullet that replaces everything else. I don't believe in silver bullets. I believe in systems. And this is one powerful, well-designed system. So after all that, the timeline, the funding commitment, the limitations, who is IBC actually for? It's for the person who thinks like a business owner. That doesn't have to be a business owner, but someone who thinks like a business owner, someone who sees money as a tool to deploy, not just something to accumulate and spend. Someone who is building towards something, generational wealth, financial independence, a legacy, and is willing to think in decades rather than quarters. It's for the person with a stable income or a business that generates consistent cash flow, someone who can make premium commitment and keep it. It's for the person who has read Becoming Your Own Banker by R. Nelson Nash, or is willing to, and understands that this is a philosophy first and a product second. The whole life policy is the vehicle, but the thinking and the philosophy is the engine. And most importantly, it's for the person who's tired with banking with the bank, the one who has looked at the system we've talked about over these last few weeks, the interest spread, the retirement myths, the savings account leak, the liquidity gap, and decided that there's a better way to be the banker in their own life. If that's you, even if you're not fully certain yet, that uncertainty is worth a conversation. You can bank with anything: a mattress, a savings account, a brokerage account, a home. All of those hold capital until you need it. The question has always been where your money is safe and whether or not you are in control of it. When you compare every option, liquidity, growth, tax treatment, protection, control, the cumulative picture points in one direction: dividend paying, whole life insurance with a mutually owned company. If you've watched the series from the beginning, I want to thank you. You've done something most people won't. You sat with a new idea long enough to actually understand it. That alone puts you ahead of the majority. Here's what I'd like you to do. If you haven't already, go read Becoming Your Own Banker by R. Nelson Nash. A part of what we've covered in this series lives in Nash's own words within that book. It's short, it's dense, and it's worth every minute. I'll link it in the description. When you read it, when the concept has had time to settle, come find me at green.wealth.com and book a free 30-minute discovery call. We'll look at your specific situation, ask the right questions, and figure out together whether or not this is the right move for you and your family. And if it's not, I'll tell you that too. The blog on the website also has some great content and is updated weekly. I'm excited to provide more videos, more concepts, more depth, more discussion, more education. Hit subscribe so you don't miss it. I'm Jared with Green Dot Wealth, and I'll see you next week.